And over here, I've also identified 7 different US and Ireland domiciled bond ETFs that cover the US and also the global bond market. Hey, what is up everyone? In this video, I'll be covering everything you need to know about bonds, the different types of them, its terminologies, and share what I think are some of the top US and Irish domiciled bond ETFs that you can consider to have in your portfolio. Let's get started. We all know that buying stocks is like you want to hold a fractional piece of a company. Meanwhile, buying bonds is more like you loan your money out to the company. Say you lend $10,000 to Z Corporation for 2 years, but no one would lend money out for free, right? Hence, Z Corporation will have to compensate you with a $15 interest fee every single month. And after 2 years, the bond matures and you will be paid back the principal, which is the $10,000 you had given out. And now you have $10,360 in hand. Easy, right? Anyways, when you are buying bonds, there are many types of bonds you can consider. Let's go through the 3 main ones. Firstly, Treasury bonds, or they call it T-bonds, which are bonds issued by the US federal government to finance the nation's operations and projects. They have various maturity period ranging from 1 month to 12 under T-bill, 2 years to 10 years under T-notes, and anything longer than that they are called T-bonds. And all US Treasury bonds are benchmarks to their comparable fixed income categories because they are virtually risk-free as they are backed by the US government. They can raise taxes and increase revenue to ensure full payments. So when someone is referring to risk-free rate, they are usually referring to the yield of these US Treasury bonds. Secondly, we have municipal bonds, a type of bond that are issued by state and local governments to finance various public projects, construction of highways, bridges, schools and hospitals, all those good stuff. And the third one is corporate bonds. They are bonds issued by companies to raise capital for various purposes, such as for expansion, acquisitions and also refinancing. And other than these 3, we also have high yield bonds, inflation protected bonds, international bonds, yada yada yada. But long story short, here's a picture of the world's 10 largest bond ETFs for your quick glance. So why bonds, right? Well, first, it offers diversification for your portfolio as the bond market is not highly correlated to other asset classes like the stock market. Hence, this reduces the overall volatility of the portfolio and helps you to stay chill in different economic cycles. And next, bonds can provide you with a stable source of income in the form of interest payments. Unlike some dividend paying companies that might announce, oh, it is a tough year for us, so no dividends for you. A bondholder must be paid with the interest payments regardless of what's happening in the market. And on top of that, if the company touchwood bankrupts and goes into liquidation, a bondholder will be treated like a preferred shareholder and hence get paid first rather than the shareholders, which are usually holding common shares. And this can be really helpful, especially if you are approaching retirement or just simply looking for capital preservation. Hey, not everyone wants to beat the market, right? And that's totally okay. And for today's context, we are speaking about the bond ETFs instead of actual bonds, as they are more accessible than the traditional bond buying. The minimum cost of investment in a typical bond fund ranges from about $1,000 to $5,000, and they can easily go up to the millions. And we are speaking of only one investment. Imagine you are diversifying into 20 different bonds. So it is simply more practical to get an ETF. Having said that, all pros comes with cons. Bonds do have some drawbacks as well because they are especially sensitive to the interest rate fluctuations. When interest rates increases, the price of existing bonds are expected to fall, causing some capital loss. And why is that so, right? Well, this is because when interest rate increases, the newly issued bond will offer a better yield. So the existing bond with lower yield might not be so attractive anymore. And to stay competitive, they will discount their price, hence resulting in the loss in capital for those who have bought into the bonds before. And also, as interest rates rise, investors may turn to bonds for safer returns, resulting in higher demand for bonds, hence higher prices and hence lower bond yields. And just like now, the Fed has been raising the interest rates like there is no tomorrow, and you can see here that all bond assets are suffering losses. Another factor to also consider when it comes to bonds is the term period, whether they are short or long-term bonds. And a good thumb rule to categorize them is to remember that short-term bonds have a maturity tenure of less than 5 years, while long-term bonds more than 10 years. Meanwhile, any bond that requires 5 to 10 years belong to the intermediate term. Pretty simple, right? So just remember this, the longer the tenure of the bond, the more tranches there are, so there will be more coupons, hence more coupon payments. And in general, short-term bonds are considered to be less risky because they are less exposed to changes in interest rates and other market conditions. Let me show you an example on why is that so. Suppose the interest rates rise by 25 bips today or 0.25%, short-term bond A with only one coupon payment left until maturity will be underpaying the investor by 0.25% for only one coupon payment. And on the other hand, long-term bond B with 20 coupon payments left will be underpaying the investor 20 times more than bond A. And obviously you would want to go for the one with higher profit, right? What is the point of buying bond B that offers lower yield when I can buy the latest bond, right? So naturally, the price of both bond A and bond B will drop, but bond B will definitely suffer a deeper cut in price. And we all know our market changes every single day, and a 2-year bond definitely offers less uncertainty compared to a 10-year bond because of its shorter duration, hence lesser exposure to market volatility. So to compensate for the shortcoming of the uncertainties, long-term bonds usually offer higher yields than short-term bonds. It's pretty easy to remember. Just think of longer term means higher risk but higher return. It all depends on how you like to manage your risk to reward expectation. So you are planning to buy bonds from, let's say, Z Corporation, because why not, right? But how do you know whether Z is able to pay money on time consistently? It is impractical to dig out all the news and do background investigation yourself. So this is where the credit rating will come in handy. And just like how banks will evaluate you when you are applying for loans, right? There are also rating agencies out there that evaluate the credit worthiness of these companies issuing bonds, with the three main players being Moody's, Standard & Poor's and Fitch Rating. They give opinions on the creditworthiness of the bond issuers based on the ability of the company to make interest payments and also repay the loan. And ratings allow investors to understand how likely a bond is to default or to fail to make its interest and principal payments on time. Basically, higher rating means the risk of defaulting is lower, which also means it's probably a safer asset that can issue bonds with lower yield. And take a look at this cheat sheet. The red line divides bonds into two. Any bond that has rating above the line is referred to as investment grade, whereas the rest that falls below the red line is normally what we call junk bonds. And to give you a better picture, US Treasury bonds are considered the safest asset, and all agencies have given the highest possible credit rating of AAA. Meanwhile, the latest Standard & Poor's credit rating for Malaysia stands at A- with a stable outlook, just to give you a sense of it. Now back to your investment in bonds issued by Z Corporation. Let's say you're holding US dollar, but Z Corporation is located on a cute little island in the Pacific Ocean and uses a pretty seashell as their currency. And what will happen is the fluctuation of value in the currencies between US dollar and the seashell currency will affect your return as well. And to free yourself from the worries of currencies, you can choose US dollar hedge bonds, as they are funds that aim to reduce the impact of currency fluctuations. And on the other hand, if you think the seashell currency has its potential and may bring you extra return, unhedged funds may be more suitable for you. And it is important to note that whether hedged or unhedged, not one is better or worse off than each other. After all, it all depends on your personal investment outlook and asset allocation in the form of currency diversification. Now, onto the more exciting part of the video, the best bond ETFs of all. And whatever I'm going to introduce you here will all be available on Interactive Brokers. So do check out the link in the pinned comment down below to open an account for yourself. In my opinion, total bond is easily the best option, as it has exposure across various markets and bond types, including treasury, municipal, corporate bonds, etc. And they often include short to long-term bonds, and they would cherry-pick investment-grade bonds to maximize diversification, at the same time minimize the risk. And the reason why I picked them here is because I'm assuming you are looking at bonds for the purpose of capital preservation and would probably appreciate more asset diversification. So hopefully my selection here is helpful to you. And over here, I've also identified 7 different US and island domiciled bond ETFs that cover the US and also the global bond market. And in case you are new here, island domiciled ETFs basically give you additional tax benefits that I've explained in detail before, so feel free to refer to this video for further explanation. So right here on the left, under US domiciled bond ETFs, we have AGGU ETF that is the benchmark of many total bond ETFs. It focuses in US investment grade bonds and is traded with US dollar since it is listed on on the New York Stock Exchange, and it comes with a very low expense ratio of 0.03%, one of the cheapest, if not the cheapest you can get in comparison to all the other ETFs here. And the second total bond market ETF is the BND ETF, which is very similar to AGG. It also invests in US investment grade bonds with the very same low expense ratio of 0.03%. However, it is listed on Nasdaq and the coverage is slightly different. AGG has top coverage of US Treasury, federal and government national mortgage, while BND focuses on US Treasury, BBB and A rating bonds. And between these two, I can say they are more or less the same. Both are equally large and liquid, and by judging from their past performance, BND performs slightly better than AGG, and their original rate is at 0.04%, with the current 0.03% expense ratio being an offer rate that will only last until 2026. Not to mention that the yield in BND is also higher too. So between these two, I would say BND is probably a better option. However, if your preference are for bonds issued outside of the US market, then BNDX may be a better option because it covers bonds from all around the world with the top coverage of mostly Europe and Asia Pacific. It is traded in US dollar, listed on Nasdaq, but the expense ratio is slightly higher at 0.07%, still within acceptable range. Dividend yield wise, it is slightly lower, but it outperforms the AGG and BND in the 5 and 1 year period. It also worth noting that all 3 US domiciled total bond ETFs distribute dividends on a monthly basis, since they are all distributing ETFs by nature. And over on the right hand side, I have 4 different island domiciled total bond ETFs for you. 2 of them invest in the US dollar denominated investment grade bond, while the other 2 invest in the global bond market. They are basically the mirror version of the US ETFs but domiciled in Ireland instead. And all bonds suggested here are traded in US dollar and listed on London Stock Exchange in the UK. So the 2 on the left are IUAA and IUAG ETF, both investing in the US investment grade bond, with their top coverage being the US Treasury, Federal National Mortgage and Federal Home Loan Mortgage. But as with all island domiciled ETFs, their main drawback would be their higher expense ratio at 0.25%, but you offset that off with the tax benefits you get. And basically they are almost the same, except IUAA handles their dividends by accumulating them, while IUAG distributes 2.11% dividend yield every 6 months. And the next 2 in line, we have AGGU and AGGG ETF, with AGGU being an accumulating bond ETF, while AGGG is a distributing fund that distributes dividends semi-annually with a yield of 1.55% per annum. And other than that, they both invest globally, with their top 3 coverage being the US Treasury, Japan government and Federal National Mortgage. And on top of that, they share the same expense ratio of 0.1%, much lower compared to IUAA and IUAG. And for what it's worth, among all bond ETFs offered here, I would say AGG or BND is the best, simply because of their lower expense ratio, and that's so important because bonds in general do not make as much profit as stocks, and if the expense ratio is high, they will probably just eat all the gains and there will be no meat left for you. So the $1 million question, should you invest in a bond ETF? Well, as much as I hate to say it, it all depends on your financial goal. Value investing legend Benjamin Graham has recommended putting a portfolio evenly between stocks and bonds to preserve capital while still achieving some growth at the same time, and he suggested having between 25% to 75% of your investments in bonds depending on the market conditions. So if your goal is capital preservation but you don't mind a lower return and potentially underperforming the market like the S&P 500, then I would say by all means go for it. Total bond ETFs offer an intensive amount of diversification to your portfolio. So if you see yourself as not a risk taker or not a risk taker yet, and you like stability and okay with minimum losses, do consider the total bond ETFs. Although bonds are usually labeled as a safer assets, it is also worth noting that bond ETFs are subject to interest rate changes. The price of market may fall when interest rate is hiking, so sometimes safe is probably not so safe after all. And as for myself, I feel like I'm still in the early days of investing, so capital preservation is not really my current goal. Perhaps one day when my portfolio grows huge enough, or when I'm ready to have fun and retire, then yeah, bonds would probably be one of my considerations. Alright, if you found this video helpful, you can check out this video if you would like to know how much money you should allocate for bonds and how much for stocks. Thanks for watching, and as always, I will see you in the next one.